Can you mentioned one thing that I just want to make sure people understand because it's a little bit counterintuitive to how we look usually at building PM businesses. You mentioned client concentration risk. Um, Explain what you mean by that.
Yeah, so it's really simple. Take how many units you have under management and divide by the number of clients that you have. So if you have 100 units and 50 clients, that would be a units per client ratio of 2, which is pretty typical. 1 to 2 in there is very normal. Once you get above 2, that's more unusual. Typically, that's like more, multifamily type properties or investors with larger portfolios. Nothing necessarily wrong with that, but there are more risks for a buyer because any one particular client, when they leave, is going to have a larger impact on the business. And it gets really bad if you have a few heavy hitters that make up, double-digit percentage of your overall unit count. So if you have like 500 doors, but 250 of them are owned by just 4 clients,
Right.
that's a big risk for the buyer. You may
Mhm.
be buddies with these guys and you know they're not going anywhere and they're your uncle's cousin and everything, but the buyer, the buyer doesn't have that relationship. And as much as you may promise to stick around and make sure that everything goes well, we all know how that really goes. And after 6 months or a year, you're gone, you're doing other things. And then if that owner churns out, the buyer, they have to price that risk in somehow, whether it's the price or the terms or some other way. And so
Mm.
if you want to maximize the dollar amount that you get and give yourself the best possible position, you just want to make sure that units per client doesn't get too high. I would be really interested actually to hear from Kit on this as well.